Hello guys, welcome to Bhavna's Online Academy. So in this video we are going to learn the chapter of investment decision. I have already put up two videos on this chapter. The first one was all the concepts. The second video covered the illustrations, and this is the third video which is going to cover your practical problems or your test or knowledge questions which is given in the book back. So in this video we have covered around 8 to 9 practical problems. So in case if you are planning to watch this video, make sure all your concepts are clear, or else you can watch both of my earlier videos and then come to this one. So without any further ado, let's begin with the video, guys. So let's start. So we'll start with practical problem number 2. Okay. So here they tell you that Lockwood Limited wants to replace its old machine with new automatic machine. Okay, before we start, all the questions are maximum based on NPV only. So try to think from that point of view, like cash flows, cash outflows, cash inflows, and in that perspective, basically. Okay, yes. So starting the question number 2, Lockwood Limited is a company and it is actually planning to replace its old machine with a new machine. Okay. So there are two new models which it can buy. In model A and model B are available at the same cost of 5 lakhs. So these two models it can buy at a cost of 5 lakhs each. Salvage value of the old machine. Okay, if it sells the old machine, the salvage value of it is going to be 1 lakh rupees. The utilities of the existing machine can be used if the company purchases model A. So here what they are telling, if you are going to purchase model A, then the old machine's utilities, means whatever leftovers like spares or other parts of it can be used. Okay. In the utilities of the existing machine, that means utilities of the old machine can be used in the utility of and can be used in the new machine. Okay. Additional cost of utilities to be purchased in this case would be 1 lakh rupees. So in model A, you can use the old machine's utilities also, and if you are using old machine's utilities, then additional utilities that you have to purchase will come up to 1 lakh rupees. Now in case of model B, if the company is purchasing model B, then all the existing utilities will have to be replaced with new utilities. You cannot use any of the existing utilities, or everything you have to buy new only. Then the new utilities will cost you around 2 lakh rupees. Okay. The salvage value of what will happen? If you are purchasing a model B, in this case, the old utilities is of no use. So now you can dispose it off. Then in such case, the salvage value of old utilities will be 20,000 rupees or 0.2 lakhs. Okay. The earnings after taxation are expected to be, so here they have given the year cash inflows if you purchase machine A, and cash inflows if you purchase machine B. And the PV factor is 15% here. Okay. And the salvage value of machine A they have given, and salvage value of machine B they have given here. They are telling you that the return on capital is 15%. You are required to compute for the two machines separately net present value, discounted payback period, and desirability factor. You have to calculate all of these three for this question and state which of the machines is to be selected. You have to tell whether you want to go for machine A or machine B. Okay. So here let's take machine A and machine E, and we are going to first find out how much is the cash outflow at year 0. So in year 0, what is the cash outflow we are going to find out. So what was the cost of machine A and machine B? It was 5 lakhs each. So that was one cash outflow. After that, what they are telling is you have to purchase new utilities. In case of machine A, the cost of utilities was how much? It was 1 lakh. In the case of machine B, it was 2 lakh rupees. Correct. So that is also in cash outflow. So cash outflow 1 lakh, cash outflow 2 lakh here. Then salvage value of old machine. So salvage value of old machine here, as you can see, 1 minute. Yes. So salvage value of old machine is, so here salvage value of old machine, that means the earlier old equipment that they had, which they sell off or which they dispose of, the salvage value they'll get is 1 lakh, 1 lakh. So 1 lakh is going to be, in any case, the old machine, if you're going to sell or dispose, you're going to get 1 lakh rupees. So that you can reduce from your cost, because that will be an inflow. If you're going to sell something, you will get cash inflow from that. So here we are reducing it from our cash outflow. Okay. And then salvage value of old utilities. Here you might get a question that what is old mission and what is old utilities. I already told you. The mission, old mission which you have, in that there might be a few spare parts or other parts which can be used in the new missions. That is what is known as utilities. Okay. So the salvage value of old utilities. In that old mission, you would have old utilities too. Here in the case of mission A, there will be no utility salvage value because mission A is going to use the old utilities, whereas mission B is not going to use the old utilities. So here the salvage value of 0.20 lakh, or here we can write it as 20,000. So here also salvage value, are going to get it as an inflow. So minus 20,000. Okay. So finally, the total expenditure or the net cash outflow at year 0 for A is 5 lakh and for B it is 5,80,000. Okay. Has everyone understood until this? Can I get a yes? Any doubts until now? I hope you understood that. Then what you have to do? You have to calculate your NPV as asked in the question. So here you can write 1, 2, 3, 4, 5. Then present value factor at 15%. They have found out here and wrote. Then in case of mission A and mission B, you have to first write all the cash inflows of mission A and cash inflows of mission B. So cash outflow is 5 lakh in case of mission A and 5,80,000 in case of mission B. And then all these cash inflows are directly given in the question. You can just copy paste it there. See here all these cash inflows and these cash inflows, you just have to copy paste it here. And once after doing that, you have to find out your discounted cash inflows. Discounted cash inflow means for mission A, it will be cash inflows multiplied by PV factor at 15%. And for mission B, it will be cash inflows of mission B into PV factor at 15%. So like that, if you find out your NPV, your net present value of mission A will be 42,580 and your net present value of mission B will be 18,140. Now, which mission should you prefer? Here, since both of the missions NPV is positive, both of the missions can be taken. Okay, depending upon the management's decision, they can undertake any of the mission. Both are positive NPV only. Okay, and then in the question, the next had asked you to find out discounted payback period. So what is discounted payback period? Using discounted cash flows, you will find out until how much period will you be able to recover your cash outflow, initial cash outflow. Within how many years will you be able to recover, keeping in mind the discounted cash inflows. That is what is discounted payback period. Okay, so here you have year 1, 2, 3, 4, 5. Then discounted cash inflows of mission A, they have directly taken it from here. We found out in the NPV, no? This they have directly taken it here and wrote it down. And same in the case of mission B, discounted cash inflows they've written. For mission A, what was the cash outflow? It was 5 lakh. It was 5 lakh. In the case of mission B, it was 5,80,000, correct? So in mission A, you have to see until how much time will you be able to recover 5 lakh. So in the year 1, you will be able to recover 87,000. In year 2, you will be able to recover 1,13,400. That means in year 2, you have to see cumulatively, including year 1 and year 2, how much will you be able to get? 2,04,000. In year 3, this much. Then cumulative of year 3 is 3,18,840. That means a total of 3 years. So if you go on like this, you get to know that 5 lakh lies between year 4 and year 5. So you will be able to recover back your 5 lakh rupees within year 4 and between year 4 and year 5. Okay, so here what you have to do is you have to find out the payback period. So you know it is 4 years. So it will be 4 years plus some amount of time. That will give you your 5 lakh rupees, which is nothing but here. How much more amount do you need in 4 lakh? Oh, 1 minute. Okay. Yes. Okay. So yes. So here what we are saying, we need, why is this not writing? 1 minute. 1 minute. So we need 5 lakh rupees. Okay, until year 4, we have got 4,33,240 rupees. So if you do 5 lakh minus 4,33,240, how much amount we need, we will get. Okay, so what will be that? 1 minute. I'll just take out the calculator. Just a second. So it will be 5 lakh minus 4,33,240. You need more 66,760. Okay. So here you have to see from year 4 to year 5, how much is the gap? Year 4 to year 5, 1 year of gap. In 1 year of gap, how much amount difference is there? How much amount difference is there? It is 5,42,580. 5,42,580 minus 4,33,240. You have a gap of 1,09,340. To get an amount of 66,760, how much will be the year gap? So if you cross multiply this, you'll get the year, which is nothing but 0.61 years. So 4.61 years will be your discounted payback period. The same steps you have to follow for mission B. The same steps you have to follow for mission B. Here, what did I do? Year 4 and year 5, in between that, my 5 lakh was lying. So I know it was after 4th year only. After 4th year, how much time period? Then you have to see from 4th year to 5th year. In 1 year, if you are able to earn 1,09,340, in how much period of time will you be able to earn 66,760? If you cross multiply and find out, you will get 0.61 years, which will be your mission A's discounted payback period. The same will follow for mission B also. Next is desirability factor of profitability index. You know, what is the formula of profitability index or desirability factor? It is present value of cash inflow divided by present value of cash outflow. So for mission A, what was the present value of cash inflow? It was 5,42,580. A total of this. A total of all your cash inflows if you do, discounted cash flows if you do, you will get your present value of cash inflow divided by present value of cash outflow 5 lakh. It will be 1.08, and the same will follow for mission B also. Okay. And here then in the question they have asked you, state which of the missions is to be selected. So which of the missions should you select? You have to tell. So here you have to tell, since the absolute surplus of in case of mission A is more than mission B and also desirability factor, it is better to choose mission A. So here they are saying here your PV index of mission A is better because mission A is 1.08 and mission B is 1.03. So mission A is better, and in the same way your PV of NPV of mission A is better. So in that case, choose mission A. The discounted payback period in both the cases is almost same. Here it is 4.61 years and here it is 4.63 years. Okay. But the desirability factor is higher in the case of mission A. Therefore, it is better to choose mission A. Here also we are able to recover the amount fastly in mission A only. So it is best to choose mission A overall. Hope you understood the question number 2. Any doubts in question number 2? Any doubts in question number 2? Can I get a quick yes? Only this question I explained in detail. Other questions I'll just go through quickly so we don't spend too much time. Okay? Any doubts? Anyone who wants me to repeat? Is it clear? Quickly. At least 5 to 6 yeses and then we can move ahead. Okay. Yes. Perfect. So now next question we are going to see is the question number 3. In that they tell Hind Liver Company is considering a new project line to supplement its range of products. So they are considering to open a new product line. Okay. Here they are telling it is anticipated that the new product line will involve cash investments of 7 lakh at the time 0 and 10 lakh at year 1. So there will be 2 cash outflows. At year 0 it will be 7 lakh rupees and at year end 1 it will be 10 lakh rupees. Okay. After tax cash inflows are of 2,50,000 is expected in year 2, 3 lakh in year 3 and 3,50,000 in year 4 and 4 lakh after and 4 lakh each year thereafter through year 10. So here what they are telling, in the second year they are expecting a cash inflow of 2,50,000. The same in year 3 and year 4 different cash inflows, and then they are telling from year 5. And then they are saying from year 5 to year 10, 4 lakh rupees will be the cash inflow every year. Every year this will be the cash inflow. Okay. Although the product line might be viable even after year 10, the company prefers to be conservative and end all calculations at that time. Okay. So they want to complete all the calculations till year 10 itself. Now they are asking you, if the required rate of return is 15% per annum, compute NPV of the project. How easy is this question? They have given you cash outflows, they have given you cash inflows. Cash inflows, you have to discount it and bring it to the present value, and that present value factor will be 15%, and you have to find out your NPV. That's it.
Okay, and the same way in the B question also, the return is 10%. So same what you did in question number A, you have to replace it at 10% and do for question number B. Now let's quickly see that. So at year end 0, it was 7 lakh outflow. Year end 1, 10 lakh outflow. Then year 2, it will be 2,50,000 inflow. Year 3, 3 lakh inflow. Year 4, 3,50,000 inflow. Okay, and year 5 to 10, it will be 4 lakh each year. Okay, so same way you have to take discounting factors for everything every year, and here you will use present value annuity factor. Present value annuity factor of 15% for how many years? 5 to 10. 5 to 10, 5 years. It will be 2.163. And so you will multiply this and will get your present value factor. So if you do this, you will get your NPV. So here, since the NPV is negative, the project is what? Unacceptable. The project here is unacceptable. Okay. And the same thing again you have to do using discount rate at 10%. Here the NPV will come as positive figure. So here you would say that the project is acceptable. Okay. So that were your first 2 points. And then they tell you that calculate internal rate of return. Calculate internal rate of return. Internal rate of return, what is internal rate of return? Where your NPV is 0 or your present value of cash inflow is equal to your present value of cash outflow. So here how do you find out? You find out by using a positive NP and a negative NPV you will find out. Okay, so here in the question we already found out that we have 10% and we had 15%. We wanted a place where our NPV is 0. At 10%, our NPV was positive, which is 2,51,450. At 15%, our NPV was negative, which was 1,18,200. This we found out in A part and this we found out in B part. Now we have to find out NPV where we have to find out a IRR or percentage where NPV is 0. So how do you find out? IRR equal to lower rate plus NPV at lower rate divided by NPV at lower rate minus NPV at higher rate into higher rate minus lower rate. If you do this calculation, you will get your IRR as 13.40%. You will get your IRR as 13.40%. I hope you understood the calculation of IRR also. And finally, they have told you to find out computation of payback period. Here, remember, it is not discounted payback period. It is just a payback period. So don't discount your cash flows, directly find out your payback period. So how much was the cash outflow? The cash outflow was 17 lakh rupees. Now you have to see in which year are you able to recover your 1 minute. In which year you are able to recover your why is this moving so much? 1 minute, guys. Okay, in which year you are able to recover your 17 lakh rupees. So if you see in first year get 2,50,000, in second year second year you got 2,50,000, in third year 3 lakh, in fourth year 3,50,000, fifth year 4 lakh, sixth year 4 lakh. Addition of all of this will be 17 lakh rupees. So within 6 years you were able to recover your 17 lakh rupees of investment. So 6 years will be your payback period. So 6 years will be your payback period. Hope this question is also clear. Okay, with every passing question, I'll not ask whether it is clear to you or not. In case of any doubts, you can directly post that in the comments. In the chat box, I'll reply. Okay, I'll reply back. That was your question number 3. Now moving on to question number 4. So here they are telling that Elite Cooker Company is evaluating 3 investment situations. 3 investment situations. Here in this question, you need to have a good amount of concentration. So you are able to understand it at first go itself. Okay, so here they are evaluating 3 investment situations. First is to produce a new line of aluminum skillets. Second is to expand the existing cooker line to include several new sizes. And the third one is to develop a higher quality line of cookers. Okay, if only the project in question is undertaken, the expected present values and the amount of requirements are given as below. Okay, our investments are given as below. So here they are telling that there are 3 projects. Project 1, Project 2, Project 3, which it is thinking of investing in, which the company is thinking of investing in. Okay, so here it is Project 1, Project 2, Project 3. So the investment required for each project is given here. And the cash inflows, future cash flows of all the projects, of all the 3 projects are given here. Okay. So for project 1, the cash outflow will be 2 lakh and the cash inflow will be 2,90,000. This is the present value. As on today, this is the value. Okay, so they have given that. Okay. So that is that you have understood. Then they are telling you if project 1 and 2. Okay, 1 minute. Yeah. So here they are telling you that if project 1 and 2 are jointly undertaken, there will be no economies. That means there will be no benefit. If project 1 and project 2 are jointly undertaken, there will be no benefit. Okay. Then they are telling the investments required and the present values will simply be sum of the parts. So here what they are telling is the investment value and the present value will be the same only. There will be no difference. Okay. Here also for this also. Fine. Now next what they are telling here is that if you take up project 1 and project 3, if you take up these both projects, economies are possible. There will be some benefits. So now what are the benefits is that because one of the machines acquired can be used in both production processes, the total investment required for project 1 and 3 combined is 4,40,000. So here what they're telling is what benefit you will have is in case if you're undertaking project 1 and project 2 together, normally how much will be the investment? It will be 2 lakh plus 2,70,000, it will be 4,70,000. But since if now two projects together are taken up, if separately we would have taken up, that would have been the cost. Now, since both projects are together taken up, the total cost will only be 4,40,000, which is a benefit to you. Okay. Now that is it. Then they are telling if you take a project, undertake project 2 and 3, then also economies are possible. Then also benefits are possible. Now here, what are that benefits? Here they are telling the future cash flows of project 2 and 3 is 6,20,000. So here they are telling separately this is 4 lakh. Separately, this is 4 lakh and this is 1,85,000. So separately, if you see, this is sum of 5,85,000 only. But if you are going to do project 2 and project 3 together, if you're going to take this both up together, you will get an inflow of around 6.2 lakh rupees, which is higher than your normal inflow. So that is one benefit. Okay. Then they are telling you if all the 3 projects are undertaken, if all the 3 projects together you undertake, then also you will have benefits. Then also you will have benefits. Okay. So here what are the benefits? They are telling that 1 lakh. So here what they are telling is if all the 3 projects are undertaken simultaneously, the economies noted will be still hold. The economies noted will still hold, meaning here we told no this 4,40,000 of outflow and 6,20,000 of inflow for separately for the other projects. These both will also apply in case if all the 3 projects are undertaken. Okay. Then they are telling you, next they are telling you, however, a 1,25,000 extension on plant will be necessary as space is not available for all 3 projects. But here they are telling you, even though you have 2 benefits, if you are going to take all the 3 projects together, there is one cost that you have to incur because the factory space is not sufficient to take up all the 3 projects together. You have to expand your factory, which will take up around 1,25,000 of cash outflow. Okay. Now you have to calculate and tell them the NPV of the project and state which project should be chosen or not. So now you have to find out what? NPV. Okay. So 1 minute. Okay, fine. I think you would have understood the question. Now let's move on to understanding the answer. Okay. So here you don't need discounting rate. Why? Because all the cash flows are given in present values only. So you don't need any discounting factor here. Okay. Yes. So here first we'll see, we'll make different combinations. So first if you take a project 1, then project 2, then project 3. So if you take a project 1, your investment will be 2 lakh. Cash flow, I mean inflow will be 2,90,000, NPV will be 90,000. 90,000, how did it come? Present value of cash inflow minus present value of cash outflow. Okay. If you undertake project 2 separately, the investment will be 1,15,000. Inflow will be 1,85,000. Present value will be 70,000. If you take project 3 alone separately, your investment will be 2,70,000. Cash inflow will be 4 lakh and your NPV will be 1,30,000. Now, if you undertake project 1 and 2 together, here there are no economies of scale. So directly whatever you are getting, you will take it up. Okay, so it will be, investment will be 2 lakh plus 1,15,000, 3,15,000. cash inflow will be 2,90,000 plus 1,85,000, which is 4,75,000. And then you will find out your NPV as usual, which is 1,60,000. Okay. Next, we are going to see if you take project 1 and 3 together. There you told that your investment required will only be 40,000. So that's 4,40,000. So that will be your cash outflow. Okay. So in case of cash inflow, will there be any benefit in the case of in case you take project 1 and 3? The answer is no. Only outflow benefit was there. There is no inflow benefit. So inflow will be 1,85,000. Sorry, inflow will be 2,90,000 plus 4 lakh, which is 6,90,000. Okay. So the NPV will be 2,50,000. 1 minute, please. Yes, sorry. So the NPV will be 6,90,000 minus 4,40,000, 2,50,000. Then next case we take up is project 2 and 3. Here you will have a benefit in case of cash inflow. Your cash inflow will be 6,20,000. Okay, that they told in the question itself. Okay. Here there is no benefit in the case of investments. Okay, you have to make the cash outflow directly only. So it will be 1,15,000 plus 2,70,000, which is 3,85,000. So then your NPV will be 2,35,000. Until this, I hope you all would have understood. Now, when you are taking up project 1, 2 and 3 together, here is what you have to remember. Here, there was one benefit, which is 4,40,000. And here there was another benefit, 6,20,000. So these both should be considered when you are calculating for project 1, 2 and 3. Okay. So let's first calculate the investment required for project 1, 2 and 3. So they told that you can use the benefit which you get. So here they told that you can use the benefit which you get when you take a project 1 and 3, which is 4,40,000. Then you are also going to take up all the 3 projects. So the investment required for project 2 will be 1,15,000. So that you take up, and also they told that there will be a plant extension cost which will cost you 1,25,000. So this will be 6,80,000 will be the total investment required if you're taking up all the 3 projects. Now, then they are telling if you take up all the 3 projects, what will be the present value of cash flows? Project 2 and 3, if you take, it will be 6,20,000 benefit. I told you. What project is left out here? Project 1. So inflow of project 1 will be separately 2,90,000. So the total cash inflow will be 9,10,000. So the total cash inflow will be 9,10,000. So you put it 9,10,000, 9,10,000 and 6,80,000. Your NPV will be 2,30,000. Okay. I hope you understood it. So here you have to now choose which is the best project which should be undertaken. Here the highest NPV is in the case of project 2 and 3 only. The NPV is 2,35,000. Sorry. Is in the case when project 1 and 2 is 1 and 3 is undertaken, 2,50,000. So that is the project that you have to undertake. Is this question also clear? Is this question clear? Any doubts? Quick. Any doubts until now? Can we move on to the next question? Okay, fine. Yes. So question number 5. Question number 5, they are telling you that Cello Limited. So here they are telling you Cello Limited is considering buying a new machine which would have a useful economic life of 5 years. So the useful economic life here is 5 years. Cost of that new machine will be 1,25,000 and the scrap value will be 30,000. Okay, with 80% of the cost being payable at the start of the project and 20% at the end of first year. So here they are telling that of 1,25,000 in year end at year 0 you will pay 80%. That means 1 lakh rupees you will pay at year 0. At the year end 1 you will pay the remaining 20%, which is 25,000. So out of 1,25,000, 1 lakh will be paid at year end 0 or year 0 and 20% will be paid at year end, first year end. Okay. Then they are telling you that the machine would produce 50,000 units per annum of new product with an estimated selling price of 3 per unit. The selling price is 3 per unit. Direct cost is 1.75 per unit. Direct cost is 1.75 per unit. So here you can find out contribution. What is contribution? Selling price minus cost. So it is 3 rupees minus 1.75 rupees will give you a contribution. Then an annual fixed cost including depreciation calculated on straight line basis would be 40,000 per annum. Okay. Here they are telling you in the first year and in the second year, special sales promotion expenditure, which is not included in the above given cost, would be incurred amounting to 10,000 and 15,000 respectively. So in first year, they will incur a cost of 10,000 and in the second year, they'll incur a cost of 15,000 for sales promotion. Okay. So this is given here. Then they are telling you to calculate NPV for the investment appraisal, assuming that the cost of capital is 10%. Easy. Again, you have to find out NPV. To find out NPV, you need two things. Present value of cash outflow and present value of cash inflow. Okay. So here, give me a minute. One second. Okay. 1 minute. Fine. So what was the question? Okay, I think the meeting is going to end. Okay, if it gets cut in between the class, you can come back, join back again. Okay, so question number 5. So here I told you that what was your contribution. So now what we have to basically do is we have to find out the cash outflows present value and cash inflows present value. For that we would, cash outflows is easy. They have already given in the question, but for cash inflows, you have to find out the net cash flow of every year. How are you going to find out the net cash flow of every year? You have to find out what is the outflow. So it is nothing but sales. So it is nothing but your sales minus expenses. You will get your contribution minus you can do your fixed cost. You will get your cash flow. Basically, whatever the cash flow is, and then using this we can find out each year's cash flow. Okay. So here they are telling you. In year 0, you had an outflow of 1 lakh rupees, and year end 1, you had an outflow of 25,000 rupees. This is nothing, as I told you in the question, 1,25,000 has been split as 2. Okay. So your net cash flow will be 1 lakh. Okay. And then in year 1, what happens? 1 minute. Okay. So in year end 0. Okay, yes. So I think everybody who had to join in have joined in. So now let's start with the answer of question number 5. So here we told what was the contribution. It was sale price minus direct cost. You will get your contribution into the number of units, 50,000 units. Your contribution is 62,500. Okay. And then you have your fixed cost. Your fixed cost is inclusive of depreciation. But in case of cash flows, will you take depreciation or will you exclude it? Can someone tell me, in case of cash flows, will you take in the depreciation or not take the depreciation? You should not take the depreciation because there is no cash movement in that. There is no cash movement in that. So you'll not consider it when you're considering your cash flows. Okay. Unless and until you don't have a tax effect. Here, as you can see, there's no tax percentage given. So in that case, you need not consider the depreciation. Okay. So your fixed cost were 40,000 per annum. And then what was the depreciation? So the depreciation will be 1,25,000 is your purchase value of the machine minus the salvage value is 30,000 divided by number of years 5. You will get your depreciation of each year will be 19,000. So your fixed cost per annum will be 40,000 minus 19,000. 21,000 will be your fixed cost per annum. Okay. So now let's calculate the net cash flows. Okay. So in year 0, you have a cash outflow of 1 lakh rupees. Okay. And there is none other inflow. Correct. So your cash outflow will be 1 lakh only. Okay. In year end 1, you have a cash outflow of 25,000 rupees. Then you get a contribution of 62,500, but you then make a fixed cost of 21,000, and then you also spend on advertising, which is around 10,000. Okay, so your net cash flow will be 6,500 only. Then in year end 2, you have a contribution of 62,000, fixed cost of 21,000, advertisement expense that you make in year end 2 of 15,000, selling expenses which was given in the question, and then your net cash flow is 26,000. In year 3, your contribution is 62,000 and you have a cash outflow of 21,000 as fixed cost, and then that is your net cash flow, and the same for year 4 also. In the case of year 5, you will get a salvage value of 30,000. You will get a salvage value of 30,000. So there is one inflow. And then you have your contribution 62,500. And then you have an outflow of 21,000 fixed cost. So this will be your net cash flow. Okay. So this will be, so here given will be your net cash flows. Okay. So now basically you have to discount them. So take all the years, take all your net cash flows, discount it at 10%, and you'll find out the present value. And here is your NPV. Your NPV is 31,712. So your present value of any project is 31,712. Any doubts in this question, guys? Any doubts? I hope this question is also clear to you. In case of any doubts, let me know. Okay. Next question. Next question is sixth question. Here they tell you that ABC Limited is planning to invest in machinery for which it is to make a choice between two identical machines in terms of capacity X and Y. So it is thinking whether to invest in machine X or machine Y. Okay. Despite being designed differently, both the machines do the same job only. Further details of the machine are given below. So they are given the purchase cost of the machine, life of the machines, and the running cost per year. Every year to run the machine, you have to incur some cost. So every year that will also be an outflow for you. In the first year in 0, you have to make an outflow by purchasing the machine. After that, every single year you have to pay a running cost, which will also be an outflow. Okay, they tell you that the cost of capital is 9%. You are required to identify the machine which the company should buy. So whether the company should buy machine X or machine Y, you have to identify. Then they are telling you present value factors. So they have given you PV factors below. Okay, this you can take help of. Okay, so now you have to basically find out the NPV and then tell them whether they should buy machine X or machine Y. That is the question. Very simple question. Okay, so here if you see statement showing both the machines. Okay, statement showing two machines. So here, as you know, the purchase cost of machine X is 15 lakh, purchase cost of machine Y is 10 lakh. Life of machine X is 3 years and machine Y is 2 years. Here one concept should get strike to you. Here there is an unequal life, but you have to compare two projects. So in this case, what will you find out? Here there is an unequal life and you have to choose between two projects. What is the concept that will be applicable here? It will start with, yeah, very good. EAC, equalized or equivalent annual cash flows or equivalent. Nobody is answering. Equivalent annual benefit. Okay, this concept I taught you in the concept class itself. I hope everybody remembers. Okay, wait, I'll just show you that page. Okay, so here you see we saw this concept, equivalent annual benefits, and how do you find it out? NPV divided by PVAF. Okay, yes. So now moving back, the running cost as given in the question was 4 lakh and 6 lakh rupees. Now you have to bring this 4 lakh of mission per year and 6 lakh running cost per year to present value. So this is for 3 years. This 4 lakh will be for 9% 3 years. So your present value is this. And then 6 lakh will be for 2 years at 9%. So this is your present value annuity factor. Okay, so you then find out your present value of running cost of mission, which will be 10,12,400 and 10,55,400. Okay, now what will be the cash inflows of the mission? Cash inflows will be 15 lakh plus 10 lakh 12,400, 25 12,400 and 10 lakh plus 10 lakh 55,400, 20 lakh 55,400. That will be your cash outflows. But here, since you cannot directly compare, here if you see like this, then the mission X is giving more than mission Y. But this you cannot compare because the life is unequal here. So to equalize this, what will you do? You will do NPV, net present value, divided by PVAF. Yes, annuity factor you will do. So if you divide these both, you get 9,92,651 and 11,68,505. Now by seeing this, you can say that mission Y is preferable. The company should buy mission Y. Has everyone understood this concept? Can we move on to the next question? The next question, it says, Ali Private Limited is planning to invest in a machinery that would cost 1 lakh at the beginning of year 1. So at the beginning of year 1, you have to spend 1 lakh rupees, which is a cash outflow. Net cash inflows will be 36,000 per annum for 3 years. For 3 years, it will be 36,000 per annum. The company has two options. One is service and the other is replacement of parts. So for smooth functioning of a machinery, they want a machinery to function very smoothly. So for that, they are considering two options. One is that they can service this machine or they will replace the machine parts. Okay. So if the company opts, I'll zoom it in. Okay. So if the company opts to service a part of the machinery at the end of year 1, at 20,000, the scrap value at the end of the year 3 will be 25,000 for that machine. If the company decides not to service the part and get it replaced instead, at the year end 2, it will have a cash outflow of 30,800 for replay. See, I mean, it will get a cash inflow of 30,800 for replacing, and plus the machinery will work for 4th year also and get operational cash inflows for 36,000 for 4th year. Okay, so it will work for 1 more year and give you a cash inflow for 36,000 if you replace the part. Okay, I'm sorry, this 30,800 is the replacement cost. This is the replacement cost. Okay, yeah, I'll complete the question and get back to the doubt. Okay, yes. Then it have said that it will be scrapped at year end 4 for 18,000. So that machine will be scrapped and you will get a cash inflow of 18,000 at year end 4 if you replace a part of the machine. Then they tell you that the cost of capital is 10%, ignoring taxes. Determine the purchase of this machinery based on the net present value of its cash flows. Net present value of its cash flows. If the supplier gives a discount of 10,000 for purchase, what would be your decision? So here they are telling you that whenever you're purchasing this machinery for 1 lakh rupees, you will get a discount of 10,000. You will get a discount of 10,000 also. Okay. And now you have to find out the NPV. Okay. Okay. Somebody had it out that in question number 6, they have told that mission X and the answer is better, but I said mission Y is better. I'm very sorry. This was a present value of cash outflow. I read it. I misjudged it as present value of cash inflows. So since we are finding out the equivalent present value of cash outflow, then in whichever cash outflow is less, that will only be better. So here in case of mission X, since the cash outflow is better, cash outflow is less, the mission X will be better. Okay, my mistake. I'm sorry. Yes. Okay, so let's move on to question number 7, answer. Okay, so now let's see the first option. Now let's consider the first option. What was the first option? That you will purchase the machinery. That you have to do in both the option. You have to purchase the machinery. That is there. But here you will service it. At year end 1. Okay, so now let's calculate the net present value of cash flows. Okay. Okay, so here NPV, first you see that you have outflow of 1 lakh rupees at year 0. Then in first year, second year and third year, you get a cash inflow of 36,000 and 36,000 per annum. So you discount it accordingly. Okay. Then after that, you get a cash outflow of you have to make a cash outflow of 20,000 to service the parts, which you do at year end 1. So you use the discounting factor of 1 year. So here you use the discounting factor of 1 year only. Okay. Yes. Then 1 minute. Okay. Then at the end here, 1 minute. Okay. Is my screen visible? And then they are telling that there will be a scrap value. Then they are telling that there will be a scrap value of 25,000 at year end 3. So then you can come here and say that there will be a scrap value of 25,000 at year end 3. So you discount it accordingly. So if you discount all of this, then your NPV will be minus 8,000 and minus 9,874. Okay, but here the NPV is negative. Therefore, this option is not considered. Okay, but in case of the supplier gives you a discount of 10,000 rupees, then in such case your NPV will be 10,000 minus 9,874. Then you will get your NPV as positive. But since here the NPV value is positive but a very small amount, then also this option is not advisable. Then also this option is not advisable here. Okay. Here, remember in the question, you have to first find out the NPV separately and give your decision. And then you have to say that if the supplier gives discount, then what will be your decision? So, two types of decision you have to give. Okay, that's why they have told it as 2 points separately here. Then option 2. Option 2 will be you will again purchase the machinery, but you will replace it at the end of year 2. So, the same thing, NPV, cash outflow, you will 1 lakh at year end, at year 0. Then you have 36,000 3 years inflow. Then 30,000 you have to spend at the end of year 2 for replacement. So that outflow. And at the year end 4, you will get a cash inflow of 54,000. You will get a cash inflow of 54,000. So here, 1 minute. So how is it 54,000? Here the scrap value plus the cash inflow. The scrap value plus cash inflow, if you do, you will get 54,000 here. Okay. So if you do so, the NPV is positive here, which is 953 rupees, which is 953 rupees. Okay. Then in case of the supplier gives a discount of 10,000, and that is also like an inflow to you only. Okay. Anything that you don't pay is also an inflow. Remember a concept that I told you in the concept class. Even if you are stopped from being paid outflow. Okay, 10,000 you had to pay, but you did not pay because the supplier gave you a discount. Then it will be considered as an inflow only. So 10,000 is an inflow plus 953. So this will be your NPV. So here the decision 2 is option 2 is worth investing as NPV is positive and higher compared to option 1. Okay. I hope this was also a pretty simple question. You all understood. Next question. Next question is Navjeevani Hospital is considering to purchase a machine for medical projectional radiography, which is priced at 2 lakh rupees. Okay, 2 lakh rupees outflow. The projected life of the machine is 8 years and has expected a salvage value of 18,000 at the end of 8th year. Okay. The annual operating cost of the machine is 22,500. Every year running cost or maintenance cost we can say. It is 22,500 you have to spend every year. It is expected to generate a revenue of 1,20,000 per year for 8 years. So every year 1,20,000 you will get a income or an inflow. Presently, the hospital is outsourcing the radiography work. So presently what it is doing, this is what the plan is. But presently what it is doing, the hospital is outsourcing the radiography work to its neighbor test center and is earning a commission income of 36,000 per annum. So here what they are doing is they are in hospital. Okay, now take a hospital. And hospital, what it can do is it can have its own X-ray machines, or it can go and it can have a dealer with them and it will tell the patients to go and take the X-ray there. If this hospital is going to tell the patients to go and take X-ray in a center particularly, then the center will pay this hospital a commission for sending the patients to them. So that way, since the hospital was not having this radiography machine, it was sending it to someone else and it was earning a commission income of 36,000 per annum. Okay, net of taxes. Now analyze whether it would be profitable for the hospital to purchase or rather it can continue the way it was continuing already. So you have to give your recommendation under NPV method and profitability index method. Tax rate is 30% here. PV factor is 10%. Whenever tax rate is given, importantly remember that a depreciation point will come. Okay. Yes. Okay, now let's move on to the answer. So here we are first determining the cash inflows per annum. So the sales revenue per annum would be 1,20,000. Then you have to spend the operating cost every year of 22,500. So the net will be 97,500. Then you have to then you have to do depreciation. Here you will less depreciation when you are finding out cash inflows because depreciation has a tax effect. First, you will reduce it here and then to nullify that effect, you will add back here. Okay, hope you remember this. So the depreciation will be 2 lakh rupees of purchase cost minus 18,000 salvage value divided by 8 years. So 22,750 is the per annum depreciation. So your net income will be 74,750. Then you will pay a tax of 30%, 22,423, see 425, and then you will get a earnings after tax of 52,325. Then you will add back your depreciation again to nullify the effect, which is 22,750, and then you will get your cash flow after tax per annum, which is 75,075. Here, remember that I told you any income that you do not get, okay, any income that you do not get is also your, complete the sentence. Let me see how many of you are able to complete. Any income which you were receiving, but from now on you will not receive because another project is going to be taken up. What will it be considered as when we are calculating the cash flows? I'll wait for a minute until you all answer. No, opportunity cost is fine. What will you do? What will be the, effect when you're calculating the cash flows? It will be considered as a cash outflow only. Any income which is going, which you are receiving all through the years, but now it is going to be stopped since you're taking up some other project, then that will be considered as a cash outflow. So less loss of commission income, 36,000 per annum. So your net cash flow after tax per annum, which you have to consider, is 39,075 here. So this point is a nice point here. Okay, so this you have to remember. Okay, good. So this is what is your per annum from year 1 to year 7. In year 8, in 8th year alone, your cash flow will be different because you'll also be getting the salvage value of mission of 18,000. So your cash flow of year 8 will be 39,075 plus 18,000 salvage values. It will be 57,075. Okay. So NPV will be from year 1 to 7. This is your cash flow after tax. PV factor at 10%. You can do present value annuity factor. And this will be your present value of cash inflows. Then in year 8, you have a CFAT of this. You will calculate your present value factor. And this will be your present value of cash inflow. So total present value of, yes, so the present value of cash inflows is this minus your present value of cash inflows 2 lakh rupees and the NPV is 16,832. I hope you understood this. So it is a positive NPV, so you can take up the project. Okay. Profitability index is nothing but sum of your discounted cash flows minus present value of cash outflows. So it is nothing but 2,16,832 divided by 2 lakhs. So it is 1.084. So if your PI is more than 1, then you can take up the project. So here the advice will be that you can take up your project since the PI is also good and the NPV also good. Okay. Yes. So is this question also clear? Now we are going to see 2 more questions and then we are going to wrap up this class. So quickly, let's go through the rest of the 2 questions. Is until everything clear? Until here is everything clear, or maybe maximum 1 question more I'll take up. And the rest we will see tomorrow. Okay. Yes. So final question for the day. Question number 9. 1 minute. Okay. So here XYZ is Limited is planning to introduce a new product with a project life of 8 years. The initial equipment cost will be 3.5 crores. Additional equipment costing will be 25 lakh rupees, which will be purchased at the end of 3rd year. So here you have to purchase 2 things. One is initial equipment you will purchase at 3.5 crores, and then after that, the end of 3rd year to purchase some additional equipment also, which will cost you 25 lakh rupees. Okay. At the end of 8 years, the original equipment will have no resale value. So there will be no salvage value for the original equipment, but the additional equipment can be sold for 2,50,000. So 2,50,000 is the salvage value of the additional equipment. A working capital of 40 lakh will be needed. So here what point has been touched upon? Working capital point. Working capital point. Tell me what will be the effect of working capital. When you at the year end 0, when you introduce, and at the last year you will take it back. So when you introduce the 40,000, what will be the 40 lakh, what will be the effect? And at the year 8th year, what will be the effect? You tell me now that in the chat box, then we'll see rest of it when you are doing the sum. It will be released at this. So here they have directly told it will be released at the end of year 8. Even if they are not telling you that working capital of 40,000 will be released at the end of year 8, you have to assume it will be released after at the end of year 8, because that is what that usually happens. The project will be financed with sufficient amount of equity capital. The sales volume over the 8 years has been given. So every year sales, how much units have happened has been given. Sales price is 240 per unit. Variable expenses is 60% of sales. Fixed cost is 36 lakh per annum. Then you have loss of any year can be set off from the profits of subsequent 2 years. Okay. So in case if there is any loss, then from the subsequent 2 years profit, you can set it off. The tax is 30%, 12% is your cost of capital, and the company follows straight line method of depreciation, calculate NPV. Okay, so a lot of points are given in this question, but it's pretty simple question again. Okay, now let's start with the question. So any question when you have to, 1 minute guys. So in any question, whenever you have to find out NPV, what you have to do? You have to find out the present value of cash outflows and present value of your cash inflows. Okay, so now here first let's find out the annual cash flows. Okay, so year 1, 2, 3, year 4 to 5, and year 6 to 8. Sales, 1 minute. So first this alone I'll show you so you're able to understand. Okay, 1 minute. Let me take my calculator also. Okay, what will be the sales at the first year? Can you tell me? Take out your calculators and tell me. Okay, 1 minute. So this is the question. Okay, so here first what they have done is, remember all of this is given in lakhs. So first in first year one alone I'll tell you, then the rest of it you can calculate. How they have found out the sales 172.80 lakhs here? It is they have taken up sales price of 240 per unit multiplied by sales volume of 72,000 units per year. This will be your sales for the first year. The same way for second year, third year, 4 to 5 years, and 6 to 8 years you have to calculate. Okay. If you calculate so, you will get your sales for all the years. Then 60% of your sales. Why is this not writing? 6. Okay. 60% of your sales will be your variable cost, if I'm not wrong. That you will find out for all the years. Then fixed cost, they have directly given in the question. It is 36 lakh rupees. You will write it. Depreciation 4375. So how this they have found out? So this is the depreciation. How did they find out this depreciation? So depreciation on initial equipment, how much it will be? 3,50,000 is the equipment cost, 3.5 crores divided by 8 years because there is no salvage value. 43.75 lakh is the depreciation per annum for initial equipment. For additional equipment, what is the depreciation? 25 lakh is the cost, 2.5 lakh is the salvage value divided by 5 years because additional equipment is only purchased at the year end 3. So remaining period will be 5 years only. So 4.5 lakh rupees is the every year depreciation cost, okay, per annum depreciation. So if you total both of these, okay, so accordingly you have to do here. For the first 3 years, only the initial equipment depreciation will come. Then for the rest of the years, this both total will come as depreciation because after that additional equipment also comes into play. So it is 4825, 4825. Okay, then after doing all this, after doing a sales minus variable cost minus fixed cost minus depreciation, you arrive at your profits. From this profit, you have to reduce your tax. So tax you will reduce. Okay. So here in the first year, what happens is that you don't need to pay any tax. Okay. So then what will you do in the year end 2? In the year end 2, you have profits. Okay. And in the year end 1, you had loss. So in case of loss, you cannot calculate any tax. But in the case of profit, you can calculate tax. But here, if you had to pay tax on 23 lakh, it will be high amount, correct? In the question, they had told you that you can set off your loss against the profits. So loss of any year will be set off from the profits of subsequent 2 years. So that what they're telling is, if you have a loss in the first year, you can subsequently use this loss for the next profit of 2 years. So here on that profit, you are able to pay less tax. On this profit, you are able to pay less tax. Okay. So here the same thing we are doing. 10 lakh rupees of profit loss is being set off with the profit of the next year. So your profit becomes 3.99, which is lesser profit. Okay, so you need, sorry, here. Okay, so here it is lesser profit, so you need to pay lesser. 1 minute. Here, sorry. Okay, I'll show you. Calculation of tax in the second year. So the profit for the year was 23,93,000. Set off of unabsorbed depreciation in first year is 10,63. Okay, so the taxable profit is 13,30,000 and your tax is 3,99,000. Okay, so that's what they have done here. I hope you understood it in a better way. Okay, and then, okay, yes. Okay, and that's what they have done for all the rest of the years. I hope you understood. Then they have again added back depreciation to nullify the effect. And then they have found out the cash inflows. Then they have found out your cash inflows. Okay. So then what you have to do is you have to calculate your NPV. Now you have the all years cash inflows. Okay. So you will go and write all your cash inflows here. All your cash inflows. You will write all your cash inflows here, and you also have to write your cash outflows. So your cash outflow will be how much? Initial cash outflow will be 3,50,000. 3,50,000 plus working capital of 40 lakh will also be your outflow, plus an outflow of 40 lakh will also be incurred. Okay, so your total outflow in the first year end 0 will be 3,90,000. So 3,90,000 is your cash outflow. Okay, and then you have your cash inflows, cash inflow. Then again you have a cash outflow of 25 lakh because of the additional equipment that you purchase. Then again cash inflow. Then at the year end 8, you will have again 2 new types of inflows. One, 40 lakh rupees, the working capital that you had put in, you will get it back again. So that inflow at year end 8 plus year end 8, you will also have a salvage value of this additional equipment. So that also will be an inflow. So all of this you have to take into picture, and you have to put in the PV factor and find out the present value of cash flows. And your NPV will be 1,61,161 lakhs. Okay. So since the project has a positive NPV, the project should be accepted. So I hope everything is clear until now. Is there any doubts in this question? So today we have seen around 8 questions, and we'll wind up the class with this. In case once everybody says anything, you don't have any doubts, and I'll tell you when the rest of the questions will be done.
So yes guys, we have come towards the end of the video. We have covered almost major portions of the illustrations and also the test your knowledge questions. In case if there is any particular question in which you're finding difficulty in, which I have not covered in the video or in the earlier video, you can comment the question number down in the comment section below and ask your doubt. I'll try to either take up that entire question or answer your doubt in the comment section itself. So I hope this video would have been helpful to you. In case if it was, please make sure to like, share and also subscribe to the channel. And please make sure to share it with your friends and leave your feedback down below. Thank you so much for watching guys. Meet you in the next video.